Welcome everybody. Welcome to the power of VectorVest globally today. What a great presentation we got today. We've got Glenn Tompkins, our senior instructor there at VectorVest. Very well accomplished, very well liked. You can't help but really enjoy the great content that Glenn puts together on our YouTube channels there. Now, just before we get going today, let's just double check the sound's coming through all okay. So we should all be coming through okay. I'll just do some last double checks here. And yeah, it looks all good to me. All right, so if you can't hear us, let us know there in the chat box. I suppose you wouldn't be able to chat, but hopefully you can hear us all in the chat box here. Let's just do one last check and balance. Glenn, do you mind just letting us know you can hear us all okay and you can see us all okay? Excellent, excellent. Well, thanks, Glenn, for staying back at 6 o'clock North Carolina time, Thursday, in the United States. Very kind of Glenn to stay back late for us. So thank you for that, Glenn. And just before we get going, I'm just going to show you, just for those of you that are not aware, on our YouTube channel there, youtube.com. And if you type in VectorVest, you can't help but find us. We're everywhere on there, and you can see Glenn does plenty of presentations here. Afternoon market action, he does mid-market updates, he does special presentations. Glenn, I think you've pretty much helped build that channel now to over 43,000 followers, and you've only been doing it for what, a couple of 2 years or something. You've built it up to 40-odd thousand. So at this point, I'd like to hand over just to Glenn for a sec there. Glenn, welcome for coming along, and I hope I've done you justice with the introduction there, but if you wanted to say something to our Australian attendees, and then we'll get going. Mm. Great, thanks, Glenn. Yeah, no, your presentations are actually what got me hooked. I was living in Hong Kong at the time, where my dad, Robert Markham, that a lot of our subscribers know well, he was he was a pioneer as such, breaking into Australia. And I recall he and I went over to the US and we met you. It was a chilly day, and we were walking from our hotel, motel, whatever it was, a hotel, and walking to the office. And I never forget just thinking, my goodness, this is freezing. And then all of a sudden, the car pulls up and friendly face says, "Hey, you gentlemen want a lift?" I'm like, "Yeah, I want to jump in. I'm freezing." So no, it's you've got an incredible knack of teaching, Glenn. I remember watching a lot of your videos, special presentations of the week in Hong Kong, and getting so much out of it. All right, so with that said, let me just quickly run through the compliance. This is what we need to do here in Australia, so please do follow us on our website there for our financial services guide. In addition, please note, no personal advice is given today. You need to speak to your financial advisor for personal advice. The stocks that we covered today, you need to speak to your financial professional as to whether they are suitable for you. Past performance not guarantee future results. Forecast, backtests used or discussed in this presentation are intended as a guide only. All right, so just be aware that actual results may be affected by known or unknown risks and uncertainties, and therefore may differ materially from the results ultimately achieved. Okay, with that out the way, let's get going. So what I'm going to do here today is I'm going to present an idea, something that I think's hot from Australia, hot idea, and then I'm going to hand it over to Glenn, and Glenn's going to tell you what he thinks is hot from the US, and we'll go back and forth such that we'll give you 3 ideas. So you'll get 6 in total, 3 from Australia, 3 from the US. So when Glenn and I were talking about how we were going to do this presentation, we thought that would add a lot of value. The theme here is simplicity. I will prove to you today, Glenn will prove to you today, that you don't need super duper complex ideas to make good money in the market. In VectorVest, you can get all the whiz and the bang and the sizzle if you want it, but you can also use it to keep it nice and simple and to make some good money using the software. All right. Okay, so first thing first, let's look at this simple idea. Why don't we find beaten up stocks? In this case, I'll show you one. So beaten up stock with good earnings, solid net profit margins. So let's just cover that earnings, the engine room of price appreciation potential. So if you're buying into a company that's making more and more money, what do you think it's going to do to the share price? It's going to go up, typically, right? Would you rather buy a company making money or losing money? Sadly, too many investors don't really understand that. They're buying into shares losing money and they wonder why they lose money. All right. Solid net profit margins. What is that fancy term? Net profit margins. It's just a simple way of saying for every $1 sale that I make, what do I keep in my hand in terms of a profit? So this being from a business perspective. So if you're the Microsoft Corporation and you sell $1 billion worth of software sales, what do you keep? So if your net profit margin's 20%, then that means you'd keep 20% of $1 billion, such a big number, I don't even know what it is. 20% of $1 billion you'd keep in your hand as pure profit. All right. Yes, no, desktop audio is on. It's definitely on. Okay, perfect. No, perfect. I've set that on, so fingers crossed it's all coming through. Okay, the other thing we want to find here is rising sales. So this ties back into net profit margin, right? If I can sell more and I've got a good net profit margin, it means I'm going to have better earnings. All right, so we're going to find those companies growing their sales. You can find a company that's got a very good net profit margin. Let's say I found your company with a 40% net profit margin. You go, wow, that's excellent. But then I tell you, the sales are pretty mediocre, and in fact, they're falling 40, 50% each year. Not going to be good, right? So we want good net profit margins, rising sales, and we want to make sure that the companies are undervalued, which gives them upside potential. How about that? All right, so without further ado, here's my first sizzling idea from Australia. It's moved me out the way. Credit Corporation. So you might be wondering, well, why Credit Corp? Credit Corp works in the business of distressed credit, credit cards, all that type of thing. Why would this be a good idea? Well, if you think about it, what's been happening globally? We're starting to see rising interest rates, or at least in the US and New Zealand and Australia, for example. Rising interest rates are going to start eating into people's savings. Why? If you've got a mortgage, you've got to pay more. If you want to borrow money, you've got to pay more. All right, we've seen inflation starting to lift up, right? So we've got inflation here in Australia at about 5 to 6%. Glenn, just out of interest, in the US, what's your inflation currently ticking at? Just roughly. Have you got sort of a ballpark figure? Wow, okay, so yours is a tad higher. So the Fed Reserve's there is probably hell-bent on wanting to lift interest rates, much like our Reserve Bank of Australia. So as you're starting to control these interest rates, the higher inflation is going to start chewing into people's savings, and guess what? This is where Credit Corp comes in. So people are more likely to probably start using credit cards. Now, there's a counter argument. Some analysts are saying, well, not really, because people start cutting up their credit cards. Let me tell you one thing that happens when things start getting difficult. People do start looking at different avenues of credit. Maybe in the short term not, but in the longer term it starts to eat away. You need money. and you're going to start probably getting yourself into a bit of debt. All right, so I believe that Credit Corp, and again, do speak to your financial advisor. I can't give you personal advice on this, but I believe Credit Corp is a good one, and the reason being is I'm going to let VectorVest do all the work for me. First thing first, rising earnings. Look at that, just ticking up yet again. Right, so up it goes. Right there, people cutting up their credit cards and the likes. Then you start seeing a turnaround here. The earnings start lifting up. It's telling me that there's more debt being taken on, at least more credit services, right? We're seeing it tick up. Right, so the next thing I want to look at then is here's our net profit margin. So you can put this on in VectorVest. It's nice and easy to find once you know how to do it. You can save it on your graphs, save the layouts. So you don't have to keep coming back to it. Net profit margin. So here we go. Here's net profit margin. Net profit margin sitting at, what's that? About 26, 27%. So 27 cents for every $1 of sales equivalent. That's a massive net profit margin. If you look at the food companies, for example, around the world, their net profit margins are normally around about 2 or 3%, but they do a huge volume, which equates to good profit, right? In this credit business here, 26 cents on the dollar. That is a very high net profit margin. All right, let's keep drilling in a bit further. So you've got a high net profit margin, but if you're not selling a lot, well, net profit margin becomes a bit fruitless. Here, we are selling a lot, all right? So here you can see the sales. Don't get concerned about the numbers as such. It's more the trend I'm trying to show you here. Sales are increasing. Sales are increasing. Net profit margin, as you see here, has been going up, and if not holding steady. So you put the two together, it's no surprises to see you're seeing the earnings going up, right? So you got your net profit margin holding steady, you've got sales growing. And then the last thing I wanted to throw in here was valuation. So VectorVest values this at just over $32. All right, and it's currently trading there at $22 odd as of the 7th of June. So plenty of upside potential. So I view this as a pretty hot stock idea. Time will tell, but certainly stacking up. So I've got a few things I wanted to share with you. So Credit Corp cut above its peers. There was an article here talking about just how powerful Credit Corp is relative to its peers, and it's talking about net profit after tax and all these figures here jumping up. So that ties back into what we're seeing with VectorVest. Another one here, Credit Corp punching above its weight in the US. So it's not just limited to Australia. Credit Corp's also in the US, and as Glenn noted, inflation there at 8%. Interest rates are going to start moving up. People are probably going to need some credit. The other thing here, Credit Corp is paying out larger dividends than last year. Now, just on that, if a company's paying out more dividends, what does that tell you about a company? So here we are, here's Credit Corp, and let's put on the dividends. If it's paying out more dividends, you see here, so it sort of went into a lull and then up it went. It's jacking up the dividends again. This tells me that this company is confident about its future, because companies typically don't increase their dividends unless they are confident. And here you see the dividend yield. Look at that, it's moving up. All right, as price comes off, it's lifting up, but still the yield there at 3.43. So why the sulk in the price? Why is the price so beaten down at the moment? It's driven at the moment by short-term price momentum. So in VectorVest we have this technical indicator, relative timing. It's looking at the momentum. You see, the momentum's been falling away, but the fundamentals are very strong, as we see on Credit Corp. So there's my first sizzling hot idea. Glenn, I don't know what you think of that, but doesn't VectorVest make it just so easy to identify all that? Mm, 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 mm. Absolutely. And that's the beauty. The market will rise, just like the tides come in and out at an ocean. It's inevitable. The market will rise at some point. What you so I can't change the market, but I can get ready with the gunpowder ready to go when things are right. The last thing you want to do is try get into a stock where you haven't got the gunpowder. You've got lousy earnings, you've got falling sales, you've got a lousy net profit margin. Then the market turns. You go, oh, finally the market turns, but guess what? Your stock doesn't really do much. Well, because it never had the gunpowder. So to me, this has got the gunpowder. We're just waiting for the inevitable hammer to fall to fire it up. All right, Glenn, I'll make you the presenter now. So if I right click on you, um, I can make you the presenter. So right click and make presenter. So I'll hand over to you. Yes, all good. I can see it. Perfect. Yeah, I really like that. I'm an Apple user too. I've tried Android. Don't get me wrong, Android's not bad, but but Apple, it just works. It's easy. I mean, there's always going to be virus problems. Don't get me wrong, but generally, you're not going to have virus issues as you would with an Android. And yeah, I've got an Apple 4K TV little box. Even though my TV's got a fancy inbuilt computer in it, the Apple 4K TV just works seamlessly with my telephone. I can take a picture of my kids, my wife, whatever have you. The Apple box picks it up. It works with the TV. It works back with my phone. I don't know what it is. They've got some sort of magic at Apple. It just works. And I don't have to muck around. I remember when I had the Android, I was forever having to fiddle, and Apple. I don't know. Maybe it's for middle-aged people like me, where you just don't have to think about it. No, I like it. I've always been a fan of Apple. I've done a couple of long call options on Apple over the years, and they serve me very well. If Apple continues to plummet down a bit lower, I'd be very tempted to buy. Okay, it costs a bit of money. Uh, mm, mm, absolutely. All right, good. All right, I'm in the hot seat. All right, what do I got? What do I got? I got a bit of work to do to keep up with that one. All right, so, all right, here we go. Here we go. So, show my screen, and let's do it. All right, so back into Unisearch here. All right, so in VectorVest. So if you're new to VectorVest, you haven't seen VectorVest, we've got this program called Unisearch. It's pretty easy to use. You just click and point. You don't need to be a programmer. You just need to have an idea as to what you're looking for. So what I've done here is I've done a very basic Unisearch. I've just said stocks, and I've gone into EPS, the earnings, engine room price appreciation engine there. So I've gone EPS, delta, just looking for a change. And all I did here is I just simply said over the last 52 weeks, so I just change it to weeks. No, I want that to be weeks, greater than or equal to, and I put in 100%. That was it. So that's how I built that line there. Just take you a couple of seconds. And I've said to VectorVest, find me stocks that have grown their earnings by 100% over the last 52 weeks. Now, bearing in mind, our EPS is a 12-month leading forecast in earnings, which makes it even better. I'm not aware. Let us know in the chat box. Anyone else do a 12-month leading forecast in earnings? I'm not aware of anybody else that does it, at least here in Australia. And what I love about this now is I'm looking to find companies that are looking to grow their earnings based also on our forecast for earnings. All right. And look at this. So I come in over here and whoa, look at this. These figures here. Whitehaven Coal. It's grown its EPS by 10,000% of the last 52 weeks. New Hope Corp, 7,300. So if you don't believe me, if you graph a given stock here, now bearing in mind this is weekly, right? All right, so weekly. So if I change this from end of day now to being weekly and over the last year, all right, and I've got our all-important EPS. So you can see that EPS has come off some very low number. Look at that, negative 0.03 through to 0.99. All right, so that's how you've got that massive explosion up there in the delta on the earnings. So I just go and pick on the juiciest ones here. So I just pick on these two here. Whitehaven Coal, New Hope Corp. These are both coal companies. Graph the given stocks. And I didn't have to spend a lot of time in VectorVest now because straight away it brings it back to me. I go, okay, well, let's have a look here. Yep, seeing a huge uplift in the earnings taking place here. Nice and undervalued too. So again, that bodes well for the future. It's undervalued based on the current earnings and whatever have you. Dividend yield, it's doing about 1.5%. So you're not buying it necessarily for a dividend. And if I continue to have a look here, momentum, the momentum, look at that, relative timing breaks above 1 here. So the short-term price momentum indicator, when it breaks above 1, it tells you that the trend is up. So we can see a very powerful trend there to the upside. All right. So you can really see that, that moving there to the upside. You can see it broke above one at 275. And what's the price now? $5.41. So incredibly powerful indicator there, relative timing as well. The other indicator I like to look at too is this one here, comfort index on a scale of 0 to 2. I'll just make this an area graph here. And when you see the CI breaking above 1, it tells you that the trend is starting to smooth. It's starting to smoothen. It's the stock's starting to become resilient as such. So when I overlay the two against each other, I like a relative timing to be above 1, along with a CI to be above 1. RT goes below 1, we wait. RT breaks above 1, CI goes above 1. There's a good potential there to consider getting in. Earnings continuing to track up, nice and undervalued. This has all the hallmarks of a great company currently. And then going back to some of the other things we looked at today, look at that net profit margin. It's because of the coal price. We'll look at the coal price now, 43 cents on the dollar. It's massive. And sales at the moment, you look at the sales there, huge uplift, a big uptick there. Let's make that an area graph, big uptick in the sales. All right, so what I wanted to share with you is the coal price. Let's just do this here. So I had a look there at the coal price. This is one of the reasons why those two companies, of course, are surging up. We've had a massive explosion in the coal price. Now, a few of you might be saying, well, how sustainable is that? Surely it's going to come back down. Well, I think when the war in Ukraine stops, I think when fears about inflation stop, perhaps. But in the short term, I'm not seeing it. That's certainly my view. I mean, what do you reckon, Glenn? I mean, do you reckon energy is going to start becoming cheaper, things like coal, or do you think it's a bubble? Mm, 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 mm. Absolutely. I mean, those coal prices are very high, but we're seeing the 12-month graph. We're seeing, over a 10+ year period, it's holding steady. I cannot see coal prices coming down in the short term with what's going on. Massive supply constraints. We haven't got enough gas in Australia currently for demand. Well, we have, but it's skyrocketing because we export most of our gas. And there's a whole lot of debate going on in Parliament at the moment and emergency meetings about what they're going to do to ensure further gas. Now, a lot of the gas goes into our cogen electric energy creating plants that creates the electricity. And if gas is heavily constrained, which it is at the moment, well, then there's more coal going into our plants to make up that energy. So, hence a big demand for coal as well as gas at the moment. So, uh, yeah, absolutely. You know what? I'll put my camera here for extra effect. I'm glad you said that. I'm glad you said that because my son said that to me the other day. I used to be an oil and gas analyst in the merchant acquisition team, and I never forget. I never forget. We spoke about clean energy, right? We have renewable energy. Renewable battery energy. You can charge up batteries, and I remember saying, at the time in one of the meetings years ago, but if you're using coal to recharge your battery, you know, your battery, it's dirty energy. You know, yeah, it's exactly right. Yeah, it's a fact. It's but coal's effectively the base load. It certainly has been the base load for most economies over the years. You know, you look at it's the key core component of the electricity is coal, and then you have the extra fill-ins, and that being wind, hydro, thermal, whatever else it might be in there. But yeah, coal has typically been the base load. All right, well, let's look at the other one. So, what was it? Whitehaven Coal and then New Hope. New Hope Corp. So that was the other one that had the very juicy explosion up there in the Delta. All right, so same deal again. Yeah, you know, look at New Hope Corporation there in the coal space as well. Look at the value, price versus value. Look at their earnings growing. Look at the huge uplift in sales. And you put in the net profit margin, you know, 36 cents on the dollar. And if I throw in growth rate as well, what are they looking to grow their earnings by? Let's see here. Wow, 38. Look at that. So it's holding steady. That's a monster. It's a monster engine at the moment. That's a V8 5-liter turbocharged. it's it's a potent one, right? So, you know, if coal holds up, I think the story holds well for New Hope. There's hope if coal holds up. If it doesn't, well, you know, watch the coal spot price. All right, so there's my second idea. I gave you two stocks, but there was my second idea. So let me do this. Let me find the attendees, and I'll hand back over to you, Glenn. Here we are. So make presenter. There we go, and there we go. Mm, 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 mm. Absolutely. You know, the other thing, Glenn, the other day I was having a look at ETFs from around the world. I did a presentation on ETFs around the world. And one thing that really jumped out were the Canadian ETFs in energy. They were going to the moon and back. And it was interesting, the gas, the oil, I can remember the diversified energies. I remember just looking at them going, my goodness, these ETFs are on fire. So we've seen that theme in the United States with oil. We've seen the theme with coal, for example, in Australia. And if you get the chance as a subscriber, you've got access to all the countries. Load up Canada and go and have a look at the Canadian energy ETFs in particular. You won't be disappointed. Oh, all right, here we go. So show my screen. Okay, thanks, for that, Glenn. Okay, so I'm back up. Right, the last one I'm going to leave you with, because I know a lot of our subscribers like dividends, and not just in Australia, globally. I mean, who doesn't like a dividend? And with inflation picking up, what better way than to bring in a bit of extra money through a consistent dividend payer? So I'm going to do two things, and I hope it's okay with you, Glenn. I'm also going to go into the US, so I don't mean to steal your market, but I wrote an essay at the start of the year, around a couple of months ago in March, 22nd of March, and I spoke about in the US, there's a category called Dividend Kings. And I can't remember the exact terminology behind it, but basically, I think a company must have been increasing its dividends every year consistently. No, no, not the reinvestment plans, but there's a category called, it's one that I researched up called Dividend Kings. And Dividend Kings are companies that consistently increase their dividends year in, year out. And to become a king in America, for example, it must be 25 years. So a company must have increased, I think it's 25 or 50, I can't remember. I think at least 25 years. Yeah, 25 years. You know, in Australia, we do not have many, and it's arguably, I'd say we have none. We don't have any companies that have consistently increased their dividend every single year for 25 years, but we have a handful that get close. So without further ado, let me show you, in my humble opinion, using VectorVest, who I would give the dividend award to. All right, drum roll, here it is. APA Group. Why? The dividends since 2007. All right, now, yes, you can see over here that there has been a little bit of sort of toing and froing where it wasn't quite sort of increasing, but the general trend over the last couple of years there has been consistent. I like the fact that it's been fairly consistent, and if you look at the yield, you run a best fit line through there, it's around about 4%. Around about 4%. Now, I'm going to share with you something, Glenn, that when I tell people this for the first time from the US, they often don't believe me, right? They often say, surely, you're kidding me? It gets better than that. What if I were to say to you, Let's do this. So I'm going to put on the dividend yield. All right, so here's the dividends, and I'll just change the graph. I did have a layout before. What have I done with it? Let me see if I can speed it up here. I did have a layout in graphs. It should be, here we are. That's what I want. That speeds it up. Okay, let's pull this back. So 15 odd years. All right, so here's our dividends. Now, you can see at the moment it's around about just shy of 5%, right? If I look at the exact yield, let's open it up here so you can, yeah, let's see. I'll just pull it out. Whoop, it's just being a wee bit slow, but it's just under 5%. There we are. I've got so much going through my computer with the live stream as well. 4.82. All right. In Australia, we have what's called franking credits. So basically, to cut a long story short, companies pay tax on their earnings, and then they distribute part of those earnings as dividends. And the argument has been, well, hang on. So company pays tax on its earnings and then distributes those earnings via dividends. And then you as the individual, you then end up paying tax again. And that's not fair because the government's double dipping. They're getting tax from the corporation, then they're getting tax from you. So we have this thing called franking credits, which effectively allows you to basically get back, in some cases, all of that tax that the corporation paid. So it's called a franking credit. So in Australia, they're paid out both in the interim and also a final franking credit as well. So you got an interim and a final. In this particular case, this company here is not paying out any franking credits, but we can get circumstances where not only do you get like a 4 or 5% dividend, but you also then get the franking credits. So, for example, our banks in Australia, they'll pay out between 5 to 6%, and then you'll get all the franking credits thrown in there as well. So the net effect is you get close to about a 7% dividend yield. You get about a 7% dividend yield paid out. So very popular. A lot of our members heard them affectionately referring to, let's say, Commonwealth Bank, for example, as being a proxy bond. So in other words, why buy a bond? Just buy CBA because you'll get a better yield than you would on a bond anyway. Of course, you run the risk of whether it goes up or down in price. But Australia's certainly got some of the best dividend yields in the world. And anyhow, so with APA here, to me, this is the one that jumped out. I thought the yield over the years has been very, very good. Averaging just over 4% from what I can see. Okay, you don't get the franking credit, but you can see how the dividends have been growing consistently year in and year out. So if you want to read up more about it too, 11th of March, I wrote about the Dividend Kings in America, and I think it was the week before. Was it the week before I wrote about the top dividend payers in Australia? No, maybe it was a week prior to that, but anyhow, if you drop us an email as well, I'll let you know where we wrote about dividend aristocrats. In fact, let's just quickly search that for you. So dividend aristo, I'll just type in the first couple of letters there. We also spoke about dividend aristocrats. So that was our equivalent to Dividend Kings in the United States. Dividend aristocrats. I'm just needing to find, where did I write about it? Anyway, it's in the VectorVest system. If you just do a search for dividend aristocrats, you will find it. Now, what I'm going to do is I'm going to load up the US, and in here, so this was the essay I wrote back in March this year, and I generated a watch list. So if you look at that essay on the 22nd of March, I think it was 22 March 2022 in Australia, and I gave you a link where you can actually download the file to then import it into VectorVest to set up the watch list. And I put together 40 stocks, the Dividend Kings, based on the research that was done. And I want to show you the net effect of all of these companies. You ready for it? All right, so you think, APA was good? Here we are. Here's 40 companies in America that are going to blow you away. All right, I'm going to pull this back. I'm going to do this. Dividend yield. Let's take off the earnings for now. Let's do this. All right, stand by. 26 years worth. Here are the kings, 40 of them. Now, of course, some of them you need to double check over the last couple of months whether there is still a king, but look at that. Look at the dividends. up and up and up and up and up and up they go. All right, you're getting about 2 to 2.5%, but hey, who's complaining? Especially considering that you're getting phenomenal capital growth. I mean, you look at that going back to 1996, the average there was what, 20 odd bucks. It's now 140. All right, so it's grown 700%, plus you're getting all your dividends. And then you can start drilling into the individual ones, and I'll just pick on the first one or two here. All right, so same sort of deal again. Look at that, look, huge uplift in the dividends again. No surprises. It's a dividend king, and I've pulled that back 26 years worth. Here's low. Lowe's, big company. They sell just about everything, don't they? Yeah, I mean it's if you want it, they got it type thing. There, it's dividends. If a company consistently grows its dividends, what does that tell you about the company? Does it tell you that the company's confident about its future or concerned about its future? I can tell you, looking consistently over the years, that if a company's cutting its dividends, chances are its earnings are going south. I mean, is that fair to say, Glenn? Typically, companies that are cutting their dividends, it's an early barometer. It's a vote of confidence, right? I mean, if they're gonna keep increasing their dividends, I guess it's a vote of confidence. So anyway, and again, I'm not going to go through all these. You can look at the essay and look through them because I want you guys to look through it. I don't know if you've had the chance to see that essay, but look at them here. Look at that, natural gas, a fuel gas company there. Look at those dividends over the last 26 years, and I'll just do the lucky last year. Genuine parts, retail of auto parts. Cars are expensive here in Australia now, second-hand cars. Absolutely. So, yeah, I was surprised. I've got an old, beaten-up old SUV that I used to take the kids to and from school. It's great. We go to the beach, you can throw whatever into it, and don't have to worry if you get a scratch or ding in it. Nothing worse than having a new fancy car and scratching it. So I thought, no, I'm going to get an old clunger that I just don't, less stress. But with all old cars, I've had to spend a bit of money getting a few parts here and there. But so there's another hot sizzling idea: auto parts. Look at those dividends. Look at the yield. GPC. So sorry to sabotage your market there for a sec there, Glenn, but I couldn't help myself. I just love those Dividend Kings. Have I stolen your idea? Oh, that's good. All right. So that's my three hot ideas. So I hope you guys got a lot out of that. Let me hand you over to Glenn for the lucky last idea. So I will make you a presenter. Here we go. Impressive. Wow. Glenn, do you mind if we just touch on that just for a sec? Because it's quite a novel concept for Australia. You know, we get interim dividends and yearly dividends, and some companies might pay 2 or 3 interim dividends before a yearly dividend, but that's about as good as it gets. We might get a company that pays 4 times a year, but certainly not a month. Wow. But what do you like earn in total for the year? Okay, I mean you get a monthly, which is great, but what's that as a yield? Whoa, 5 to 6. All right, so it's not bad. You know. Mm, 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 mm. Wow. Mm, No. Do you mind graphing that one and just putting on the DivX and payment dates? It's going to be interesting, right? It'll be lots of them. Wow. Yeah. Mm, mm. Good. Mm, mm. Good. Yeah. Glenn, I mean, it could be a good bottom fishing type opportunity for dividends, so to speak, a bottom fishing dividend opportunity where you wait for this share to bottom out, whatever it's going to end up doing. As the market turns, you then potentially could have the opportunity to buy into a company that pays a monthly dividend where, yeah, exactly. So hopefully, you get it on the bottom as it starts rising. Not only are you getting the capital appreciation on the turning point for a bottom fishing, but you're getting the monthly dividends along the way. Mm, mm, mm. Yeah, I like that. It's actually got my creative juices going. I'm thinking to myself, a monthly dividend paying bottom fishing strategy. Yeah, that's it's a novel concept here because yeah, we certainly don't get that. I mean, 4 times a year if we're lucky with some of our better dividend players, but that's about as far as it goes. Maybe there's one or two more. Pretty good, pretty good. Well, hopefully I've shown you something too from our side. All right. No, look, that's excellent. If you want to wrap up and then because we've just come on the hour, so we've done well. We've stuck to our time perfectly. Well done. All right. Yeah, I mean we were doing VectorVest Basic, and that's that's what I say to a lot of our subscribers. You don't have to go into super duper complex stuff. I think the ideas that we covered today were simple. Here, I'll show my screen. We're simple ideas, but valuable ideas. You know, sometimes the best things in life are simple things, right? You don't need super. I mean, yes, if you want, we can come back and do a presentation on MACD crossovers and stochastics and Fibonacci arcs, and we can go into different theories behind Elliott wave and all that stuff. But I think what we've shown you is just as powerful. Quite honestly, I've gone down those tracks. Believe you me, I'm a very technical person, believe it or not, by nature. But I deliberately make an effort every time I present a VectorVest to appeal to the masses, and the masses have said to me they want simple ideas. If I start going off in super duper complex tangents, we can start losing people. I'll cater to 5% of the tradable investing population, and we lose 95% of people. And that's why Dr. DeLito put VectorVest together right from day one. It was such that everyday mum and dad investors could have the tools to do it themselves, because he was tired of seeing investors lose money from the so-called experts who would give you the whiz and the bang talks, but invariably lose you money. And that's what I love about VectorVest. It just gives everyday mum and pop investors the tools that quite frankly, I think a lot of high-end investment managers would be quite proud of. All right, so now look, if you like what you've seen today and you're new to VectorVest, you can hop along to our website, vectorvest.com.au. You can take out a 30-day trial for $9.95 USD. So call it 14 Australian dollars at current exchange rate, between $13 to $14, and you can trial it out for 30 days. And go back, watch this recording. We've recorded it. We'll get it out to you, and test out all those ideas. So I guess, Glenn, yeah. Mm, mm. Yeah, no, well said. And you know what? I'll leave you with one last thing. Here we are. Let me put my money where my mouth is. I am following, actually, no, it's in the US market. I need to be in the US. It's Australia. Here's US. And if I go into my portfolios, here we are. And my portfolios, here we go. I've shown this in the Q&A sessions as well. But here it is. This is my actual portfolio. No, I didn't start it back in 2012. I started it in recent times, but here it is. I'm following that portfolio. I've done the back testing. I've done the stress testing. It's now mechanical, so I don't have to stress anymore. So right now, the reason I started at 2000, Glenn, and here's, and again, I don't want to get into too much training here, but a lot of our subscribers, there's a big debate going on as to how do we follow a portfolio. Do we start from scratch, or do we follow it from the existing portfolio and then you jump on at this point in time, or do you start from scratch? This portfolio, the way I'm tracking it is I'm following it from the existing legacy. So what I did, the reason I started with $2,000, because I wanted to end it with the amount that I was looking to invest. So I had a spare 7,000 US lying around after a couple of successful trades, and I wanted to give this portfolio a shot. So I went, okay, well, if I back test it since 212 and end it at a value that I've got to invest right now, and then just basically follow it thereafter. So the portfolio is worth about $7,200 all up. It's got nearly $3,000 in cash. It's a total value of $7,200. And these are the stocks it currently owns. So all I've done is I've just gone and bought the exact quantities, and if I stopped out and have to buy back in, I'll have sufficient cash to continue to track this as it is. So that's just one of the many facets of VectorVest as to how you want to use the tools. It's up to you at the end of the day to to use the tools as you see fit. So this was just an example of how I use backtest, and it makes my life easy. I don't have to worry anymore. I just simply follow it now, and it gives me peace of mind. It gives me more time. I don't have to sit behind my computer as much. All right, so we'll wrap it up there. I hope you got a lot out of it. Thanks, Glenn. It's getting late your time now. It'll be, 10 past 7. You must be hungry. Dinner time, man. All right, folks. Well, thank you for everybody coming along today. Hope you got a lot out of it. Until next time, bye for now.